U.S. price and jobs data releases are likely to create both confusion and debate over the course of the economy and inflation over the next several months. First, there are no signs of a U.S. recession in the jobs data we have seen in 2023. The emergence of a no recession consensus has worked, at least so far, to push long-term Treasury bond yields higher. Second, while the U.S. labor market is trending a little lower on monthly job creation, job growth is still robust when compared to pre-pandemic patterns. At the same time, the unemployment rate is sticky below 4%. Part of the challenge of analyzing the unemployment rate is while job creation may be slowing a bit, the labor force, that's the denominator of this ratio, it's not growing much at all. That means that even small increases in monthly job creation can keep the unemployment rate very low. Third, headline consumer price inflation has been moving steadily downward from its peak of 9% in June 2022 to 3% in June 2023. Progress from here, though, is likely to be exceedingly bumpy. The biggest challenge in the year-over-year percent change was that gasoline prices at the pump started to fall in July 2022, and they are now rising in 2023. That is, falling energy prices over the past 12 months were critical to the declines we witnessed in the headline CPI, and that trend in energy prices has now reversed. Finally, the up and down volatility in the pattern of monthly data may increase over the rest of the year. The challenge here relates to seasonal adjustment. The pandemic disrupted pre-pandemic patterns and seasonal factors. Economists typically prefer to focus on seasonally adjusted data, but we would suggest caution is advised. Many seasonal factors have shifted, potentially creating more volatility in monthly data. The bottom line is that with current data showing no signs that the U.S. economy is headed into a recession, and with headline inflation possibly having seen its best number of the year back in June, market participants are revising expectations for everything from GDP to inflation to bond yields, and that's happening in the context of more volatile data releases.